Right now, Tesla is trading around $450 a share. But what if I told you that price isn't real? You see, Tesla isn't just one company, it's two companies. On the left, you have a car manufacturer. It builds metal boxes, sells them for a profit, and is worth at best about $30 a share. On the right, you have a promise of AI, robotaxis, and infinite growth. That promise is currently valued at over $400 per share. Before we go further, in the interest of the full transparency, I need to state my bias. I'm currently short Tesla stock. That means I have a financial position that profits if the stock price goes down. I am putting my money where my mouth is because I believe the research I'm going to show you is accurate. But I'm not a financial advisor, and this is not financial advice. I am sharing my analysis so you can decide for yourself. Now, let's look at a lawsuit that could delete that 400 premium overnight. But right now, as we sit here in late 2025, that $400 premium is facing a death sentence. A massive class action lawsuit is moving towards a trial that could legally declare full self-driving a fraud. If that happens, the AI valuation evaporates overnight. Today, I'm going to show you the exact financial math, the P ratios, the margin calls, and the institutional laws that could send Tesla stock crashing all the way down to $15. For years, the Tesla bear argument was they were going to run out of money. That didn't happen. But in 2025, something much scarier happened. Teflon wore off. Tesla used to win lawsuits by blaming the driver. You didn't read the manual, you didn't keep your hands on the wheel. And it worked until August 2025. And that's when everything changed. In Benavides' case in Florida, a federal jury didn't just say Tesla was wrong. They said Tesla acted with gross negligence. They hit them with $200 million in punitive damages. Punitive damages are punishment money. Is the jury saying, we know what you did and we are going to make sure you never do it again. That verdict broke the seal. But the real danger isn't crash lawsuit, it's the fraud lawsuit. In August 2025, Judge Rita Lynn in San Francisco certified a massive class action. This isn't about one person crashing. This represents roughly 500,000 owners who paid up to $15,000 for full self-driving. The plaintiffs argue that Tesla committed fraud. They allege that Tesla knew back in 2016 that the hardware couldn't do it, but they sold it anyway to pump the stock price. If Tesla loses this trial in late 2026, the cost establishes a legal fact: FSD is a fraud. And here's why that matters for your portfolio. Wall Street can ignore angry tweets. Wall Street can ignore YouTube videos. But Wall Street cannot ignore a federal fraud verdict. If a product that justifies 90% of your valuation is ruled a lie, the valuation has to go. Now, I did some digging into the current numbers, and this is where it gets scary. Right now, Tesla is trading at a P ratio of 312. That means investors are paying over 300 years worth of earnings for the stock today. A typical P ratio for a car company is around 10. So why do people pay 300x? Because they think Tesla is not a car company. They think it is a tech company. But if the court says that the tech is fake, Tesla becomes just a car company, and car companies trade at a P ratio of around 10. Tesla earns around $2 per share in profit per year right now. So if you apply premium car company multiple of 15x, 2 times 15 equals $30. That is the rational bottom. If FSD disappears, Tesla is highly successful car maker worth $30 a share. That is a 90% drop from today's price. But it gets worse. Markets aren't rational. When they panic, they overshoot. If Tesla crashes down to $30, two massive forces kick in that could push it down to $15. Force number one, the institutional exodus. Pension funds, sovereign wealth funds, and major ETFs often have strict rules. They cannot hold stock in companies convicted of corporate fraud. If a jury delivers a fraud verdict, these funds are legally obligated to sell. They don't care about the price. They just hit sell. Millions of shares flood the market with zero buyers. Force number two, the margin call. Elon Musk has billions of dollars in loans secured by his Tesla shares. If the stock price drops below a certain level, analysts guess around $30, the banks will panic. They will seize his shares and sell them to cover the debt. This creates a debt spiral. Selling creates lower prices, which trigger more selling. That is how a $30 stock momentarily crashes down to $15. Is this guaranteed? No, because Tesla has an escape hatch. Just last month, in the Tran case, Tesla settled days before the trial. They wrote a check to make it go away. I predict they will do the same here. In late 2026, right before the jury is selected, Tesla will likely announce a $10 billion global settlement. They will pay billions to avoid the word fraud. It will damage their cash reserves, it will hurt, but it will save the stock from going down to 15 or even zero. So I forgot to answer an important question. You must be asking yourself, so if they will just pay, why did I short the stock? Well, I shorted the stock because I believe we will have a recession in 2026. So not only Tesla, I believe everything will go down. And in combination with these lawsuits, the pain Tesla will feel will probably be larger than the rest of the market. So that was the reason why I shorted the stock. So here's a question for you. Do you hold through the lawsuit hoping for a settlement, or do you get out before the fraud verdict hits? Let me know in comments below. I'm Orhan and I will see you in the next one. Thank you.